Hello, everyone. Welcome, welcome, welcome. We are so excited to have Greg Davis here. And I found a quote that I really feel like this when you hear his information about him, his bio, how fitting this is for him and for all of you who are affirming your worth. Try to discover the road to success, and you'll seek but never find, but blaze your own path, and the road to success will trail right behind. So wait till you hear about Greg. He just kind of blows me away. He and I met, well, we've met a few times, but we had a nice long conversation a few months ago, and he's just really this amazing young man. So Greg is partner at Heritage. He serves on the investment committee and also oversees company growth initiatives, as well as strategy and analysis for direct real estate investments made by the firm. Before joining Heritage, Greg served as Senior Vice President of Peak Capital Partners, a multi-billion-dollar multifamily private equity company where he oversaw acquisitions, capital raising, and operations of multifamily assets in select areas of the United States markets. Before joining Peak, Greg was Vice President of Capital Markets and Investor Relations for Excel Trust, a publicly traded shopping center REIT. And it's on the New York Stock Exchange, and the letters are EXL, where he led institutional fundraising efforts to fuel the company's rapid growth. Following the sale of Excel Trust to Blackstone for approximately $2 billion, he continued working with Blackstone Shopping Center platform, leading out on the several net operating income maximization and efficiencies initiatives as the portfolio grew from $2 billion to $6 billion. So he's got that trail blazing right behind him. Greg has a bachelor's degree from Brigham Young University, and I'm so proud and excited to have Greg Davis with us today to talk about how partnerships are so important.
Thank you for the opportunity. That's a mouthful. You did a very nice job. I think some of my business cards didn't even hold that whole title of like Vice President of Capital Markets and Investor Relations. I had to get like bigger cards.
Yeah,
exactly. It was a fun. It has been a fun and enjoyable ride to learn more and more about real estate and investing. I feel like every day I'm learning something new, and I enjoyed our conversations as well at that conference, Peggy. And as we were just discussing certain things, we talked about the value of partnerships and knowing what you don't know. And she kind of had this moment where she said, that's actually kind of an interesting topic I'd love some of our listeners to think about. So I just prepared a few thoughts on that topic and the power of good partners, knowing what you don't know. So I think implicit in that title is that we can actually gain in power when we acknowledge areas areas where we may not be experts, right? So I think oftentimes if we say, hey, I don't know something, that can feel disempowering. But I think we'd like to flip that on its head and say that's actually wildly empowering, because then it sets you out on a search. And that search can lead you again on that path and that trailblazing to new areas and to new heights. So just put together a few thoughts on that power of knowing what you don't know. So I'm going to share a screen here, if you don't mind, and tell me when you can see this.
You're going to tell us everything that we know we don't know, which will take, what, 18,000 years?
That's right. That's right. I won't do that.
Okay.
Try to list everything I didn't know. The books would be voluminous. But tell me if you can see this, by the way. Are you able to see?
Yes.
Okay, because
we're good.
it's missing a green outline. So you can see the blue screen that says the power of good partners.
The power of good partners, knowing what you don't know.
Usually there's a little green outline, but since I trust you guys. So you can see this image of Kami Rita. Can you see that?
Yes.
So any idea who this person is?
You already told me, so I'll stay out of it.
You'll stay out of it. So I read a little article about Kami recently. So Kami Rita is kind of dubbed Mr. Mount Everest. He's a Sherpa, and he recently completed, just I think a month ago, his 30th summit of Mount Everest, and is apparently holds the current record for most times up and back. Interestingly enough, the same day that he completed his 30th, an individual by the name of Kenton Cool, and I don't think they were in the exact same group, but he summited for the 18th time. He's from England, and he said this. He said there was a quote in this little article I read. Mr. Cool is also a mountaineering guide and has previously played down his achievements, telling AFP News Agency in 2022 that so many of the Sherpas have so many more ascents. Something about this dynamic intrigued me. Here you have somebody who is a mountaineering guide in Mr. Cool. Great name, by the way. Kind of jealous of that. And when he made his 16th summit, so he'd already been to the top 15 times, he still had with him 2 Sherpas. Now, why is that? Why is it that someone who's so experienced would want a Sherpa to come along? And why are Sherpas so valuable? So having good partners can be critical to your success. And I think there's a lot of parallels we can draw in our financial journey that might relate to having a good Sherpa, having someone alongside. They can lighten the burdens that can come with wealth. Just as a Sherpa might be able to carry some of someone's backpack and actually lighten the physical burden. In our financial journey, I think it's incredibly valuable to have people that can also lighten that burden. They bring valuable life experiences. I have no interest in going to the top of Mount Everest personally. I'm just going to own that. But if I did, who would be my first call? It'd be Kami Rita. This guy's been up there 30 times. I'm going to want the person that's been up there the most number of times and come back successfully. So good financial partners are the same way. They'll have valuable life experiences. They'll have learned the lessons from success. And they will also be able to help us all avoid common mistakes and pitfalls. I think we can really learn from that experience. So there's some questions to consider when we're thinking about finding good financial partners. And I think that some of these are introspective questions we should think about asking ourselves. So does one area of expertise make me qualified in another area of expertise? Does being smart mean I will be a good investor? What makes a good partner? And how do I know who I can trust? Here's some things that we run into a lot in the in the financial services and investing space. So while my background has historically been significantly focused on real estate, I currently work as a partner in an SEC registered RIA advisory firm where we do all kinds of investing: real estate, private equity, credit, etc. And we find people come to us with all different kinds of mindsets. Some people are very anxious for that partnership. They're anxious to say, hey, I was really good at X, Y, and Z, but I don't know anything about this. And others come kicking and screaming, either at the behest of a spouse or because they've learned some painful lessons and possibly lost some money and realize that maybe they need some good partners. So when we think about that introspective question, does one area of expertise make me qualified in another area of expertise? Does running a successful shoe business, selling it for a large sum of money, does that guarantee success as an investor? Those are really different roles and experiences, right? And people really struggle, and what we find is they struggle confusing their capability with their actual ability. That person who built that shoe business might be really smart and might be capable of becoming an incredible investor. However, if they've not spent any time investing in the last 20 years, they spent all of it running a shoe business, I think it's important to realize that maybe having a partner who has experience is really worth looking into. Does being smart mean I will be a good investor? I thought about this comment, right? I've read a book about how to climb Everest, therefore I'm now ready to climb it. Is it that simple? Can we be smart? How about experience? How important is that? I will tell you that there's a lot of smart people we've met that can do really fantastic analysis and never pull the trigger on an investment. Or they can pull a trigger on the investment and they can freak out about it and want to undo it. Emotions are a real part of the investor roller coaster. So having partners who can, be steady and stable throughout that and who have experience, I think is really important. You've heard me say it 20 times already. What makes a good partner experience really matters. And a partner that will listen and process feedback when you're making investments. I think it's really valuable to have people who will be able to take questions from you, listen to that feedback and answer them thoughtfully and intelligently. Bernie Madoff is famous for when people would ask questions about his investment, he'd say, it's not for you. And he'd tell them to go away. And that would make them want the investment more, right? And so they probably had good questions and probably would have detected his fraud. I think a good partner will listen and process feedback. How do I know who I can trust? Understanding incentives really matters. Structures and due diligence matters. Whether you're doing a real estate deal, whether you're picking a financial advisor, whatever it is, it's so important to understand what the incentive is. When we're underwriting real estate deals, we're always appreciative that there's probably an acquisition fee, but we never want that acquisition fee to be so large that that person loses sight and focus on the success of the property, right? If it's a 7-figure or beyond, it's how important is it to that person that then that property is wildly successful from an operational standpoint. We love it when there's some participation in asset management fees along the way, but that they're highly incentivized for a successful exit. Understanding structures, partnerships, and private placement memorandums does matter. And if you don't think the right partner exists, search harder. So I was having a conversation the other day with an individual who was contemplating using our services for their wealth management, but he's really kind of treating us like he only wanted to do a single element with us. Like, hey, maybe I'll do this piece with you guys. And I kind of called him out and I said, look, if you're just looking for a single investment, that's not normally how we work. We usually work with, holistically with the entire plan. We do tax planning, we do private investing, stock and bond, we do the whole thing. And so if you're just looking for one piece of that, we may not be the right fit. And he said, oh, well, maybe that's true. Maybe it sounds like I'm only looking for an investment, but maybe I just haven't found someone that actually offers everything I'm looking for. And so let's talk about that. And I thought that was a really good point that he made. And I said, hey, maybe or maybe not. So when he interviewed us, we've gone through, I think we went through 3 or 4 calls with him, and he realized that we really did have the breadth of offering that he wanted. He's agreed to become a client. So we're in the process of onboarding him right now. So I really want to emphasize that if you're that person that says, no one thinks about my money the way I do, and no one's really got what I want, keep looking, keep interviewing, because one thing I've learned in this business is it's out there. There are service offerings for every level of individual and sort of a wide variety of needs. So you're just not looking in the right places or hard enough is my tough love comment. The help is there. The right partner's out there. So, with that, I was just going to share, just maybe take 2 or 3 minutes to share some thoughts about ways in which we try to be that right partner for our clients. So I'm going to talk a little bit in the abstract in hopes that it might trigger thoughts as to the kinds of partners you want in your lives, right? So some of my comments will be specific to wealth management, but I think the principles apply more broadly to groups like, the nest egg builder, who might be a good partner for you to do real estate investing with, and other partnerships that you create. Think about what role you want them to play. We did an educational strategies dinner recently about tax strategies and private market investing, and we're savvy on a number of different ways to be tax efficient, stocks and real estate and exit planning and in private investments. We chose to focus on one. And as we went through that, we shared with people a variety of ways in which they can be thoughtful about the structures in which they hold their investments. That, these qualified accounts like 401ks and IRAs are fantastic. If there's any limitations, that they're usually not enormous, right? The sums of money you can get in there are usually in the tens of thousands, sometimes in the hundreds, and occasionally in the millions, depending on what structures you use and how well they've done, how long you've been in them. So we like them. If the constraint is that it's been too small, there's some other opportunities in the charitable structuring space. right? So the ways in which we partner with our families is we say, what are your needs? What is the breadth and scope? What is the intention? Do you want to get tax write-offs on these and income for life? Do you want to use any of these 6 or 7 structures on the left-hand side of the page? And so, the ways in which we partner and help make our families smarter is not that we are estate planning attorneys that are going to do these trusts, but that we know the estate planning attorney and we know the tools. And we're on the side of the table of our clients to say, how do you want to use these tools? What is your ultimate outcome? One of the things we find in a lot of investing and a lot of wealth structuring is that when you're a hammer, everything looks like a nail. When you're a surgeon, everything looks like a surgery. When you're an estate planning attorney that focuses on crats, everything looks like a crat and an estate planning problem. We don't, and so the value that we bring as a partner is to unwind that a little bit and say, yes, that's a cool tool if you want to do X, Y, and Z. Is that what you want to accomplish? No, I'm really more focused on this. Do you want to maximize the money you give to your children, or do you want to maximize the charitable giving? And being that agnostic partner to help navigate those decisions, we think is incredibly valuable and important in people's lives and the financial decision making. And there's a number of other structures that we kind of talk through and say that here's a structure that we can use if people want to put millions. If they say, hey, I've got significant means, I've got a portion I'd like to grow without paying state and federal tax again, there's a structure we can use where they can do that. And real estate can be held in it, stocks and bonds can be held in it, and so can other private investments. So educating our families and clients, a good partner should be an educator, we feel. And some of those savings can really compound over time. Again, I'm not trying to take you down this rabbit hole of this is exactly a fit for you, but when we educate our families, we do the math on how people are investing their money and, make them aware of things they can do to be a little more savvy. This is kind of an interesting little graph to share recently. This is a recent look at Yale's endowments and the ways that they actually invest. So what's interesting about this is they are 75% allocated to alternative investments like real estate, like private equity, venture capital, and they were only 2.25 in stocks. Isn't it interesting that so many people have 60% stock, 40% bond portfolios and do almost nothing in alternatives like real estate? Always kind of interesting to see what some of the savvy institutional players are doing. So I thought that was kind of an interesting data point to bring up and share the fact that part of the reason why it is this way is they have a long-term view and they realize that returns over long periods of time have been strong and even stronger than simple stock market compounding in a lot of these alternative asset classes. So I'll stop there. This will be the last chart I kind of want to go over, and then just to say one cool study that was done by JP Morgan. They went back and they back tested some results and looked back to 1989, and they wanted to see what role alternatives like real estate, private equity, et cetera, could have on a portfolio. And they said if there's a 30% allocation to alternatives, what would that have done to people's returns? And it would have done what's kind of the holy grail of investing work, right? It would have reduced volatility, so smaller drawdowns, right? And maybe, more measured upsides, but, less volatility and increased returns. So if you can reduce your volatility and increase your returns, there's a reason to be in alternative asset classes like real estate. So I'll pause there and turn it back over to Peggy.
So you're going to reduce your return?
Increase your return. So this particular chart right here, so this chart right here, where that's circled in red, this says what would have happened had there been allocations to hedge funds, real estate, private equity, that sort of equated to 30%, and the median returns in those spaces. If people had allocations to that, what would that have done to the returns over, what would that be? 30, almost 30 years, 25 years, right? What would that have done? And the answer is your blended return would have exceeded 9%, averaged almost 10%. So it would have been the highest returning space if you had in there, according to their math, 30% alts, 50% stocks, 20% bonds. And it would have been way less volatile than if you had 80% stocks, 20% bonds. So it would have returned a higher rate of return, and it would have moved around less or been a little less scary. The ride would be a little less frightening.
And where's the comparison to real estate?
So this was more of a if you have alternatives like real estate into it. So the data that I've seen around public REITs and private real estate has suggested that over long periods of time, and there's different decades, but the last decade we looked at average real estate returns on the private markets, as could be measured by funds like Preqin and others, was around 9%. And average public market returns during that same period was around 5%. So
In real estate?
Mhm. But I think I'll put it this way.
From 89 to current?
So you asked a little bit of a difficult question, right? You kind of said, what are the returns in real estate over long periods of time? There's both public markets and private markets. Public market data is relatively easy to quantify.
Sure.
To go back and look. Private market data is not so much, but there are a few reporting agencies. Again, there's real estate funds through Preqin and a few others. So they were able to look at some blended real estate fund results. But to say, universally, what would, how did private real estate return over a 20, 30-year period? Well, the question is industrial, hotel, apartment, what kind, what state, what size?
True.
Pretty hard to get the data on it. But for what was publicly available, those funds, I think, averaged 8 or 9%.
Okay. That's good. So does anybody have any particular questions to ask Greg? 'Cause I have a list. I don't know. You talk, it comes right through my fingers onto the paper. My first thought was, because I don't know exactly what a Sherpa does except to get you to the top of the peak. Wouldn't they have done more, or do they not go to the top of the peak?
My understanding is that they go with you. Yeah, they go beyond base camp.
So they go to the top of the peak with you?
That's my understanding.
So they've done way more than everybody else has.
Oh, yeah. Yeah.
Right.
And that kind of experience, it's an interesting question, right? Do you want somebody who's smart, or do you just want something that's experienced? Ideally, you want both, someone who's smart and experienced. But I mean, that kind of experience, I mean, it's priceless. I mean, they're going to look out, they're going to see a cloud, they're going to know what's coming. I think having that kind of experience is super valuable in life to have. What if we could have those kind of experts in all these other areas of our lives?
We do. Well, we do have them in real estate when people are actually paying attention, and there's some economists that actually pay attention to what's really going on instead of listening to all the other, I don't know. I watched this movie called The Big Short, where you had to actually be paying attention to what actually was going on because the reporting from the government and the banks were false.
Yeah.
So, yeah, this
That's
again,
a great example.
partners. Finding the partners that are specialized and have the experience, the Sherpas, if you want to call them, they're super, super important. Just so super important. So I know who's invested in my, yeah. So when you were talking about that gentleman that came in and he wasn't sure if you and he were good partners, it's the question. It's not necessarily that somebody has never invested in real estate before. It's, again, what they don't know, they don't know. They could be very good at areas that would make them really great investors, but because they have never dealt in that world before, they need to be educated, which is what we're all about, educating people. They would ask the specific questions, we certainly would educate them.
I think that's an important point. So this concept of don't confuse capability with ability. And I made the joke, I'm looking at you, doctors. If I'm being transparent, doctors and frankly, engineers are some of the last people to become good clients, because by design, they're the smartest people in the room and they know how to do it. Just give them time. And no one's going to begrudge that. We don't invest time anymore at our company trying to convince somebody that they should trust us and that we actually know more about investing than they do. We just tell them what we do, and that we believe we can be a help. Because converting that personality who says, I'm the smartest guy in the room, I've got this figured out, just give me a week. That's just not a good use of time. It's hard, right? But I think what's beautiful about what you built in Estate Builder is you already attract people who are saying, I want to know more, and I want to partner with people who've done this before, who've done a real estate deal or 20 or 50 and who've been in the space a while. Peggy, from speaking with you, you've been in and around real estate for a very long time. And there's a lot of wisdom to be drawn from that. So that's the beautiful thing about this community is I think people are mostly already bought into that concept. But there are other levels of financial planning that if you just try to do it yourself and go too deep because you're convinced no one cares about your money more than you, I just feel like you haven't found the right partner.
Well, part of
So,
that's true. Nobody does care more about your money than you.
so Greg, I resemble that remark about engineers. I
It was a little bit of a personal attack, wasn't shot across the bow. What was beautiful about this crowd is I say it not in an attempt honestly to not in a venting session, but in a self-awareness moment of like, um, I'll give you a real world example. One of our high net worth clients who has tens of millions of dollars has started several successful companies as an entrepreneur. He was retired at 26, then got bored. Started a couple other companies, including one that launched the pool noodles. Really, really cool story. It actually started out as like an industrial use, covering pipes in the winter and turned into this incredible business for him. He was that person that finally made the leap from like, I'm going to trust somebody else and I'm going to take a board of advisors seat when it comes to my wealth. And I am going to care about it and stay close to it, but I'm not going to take a CEO, COO, president, boots on the ground. I'm going to hire, Heritage to do that. And once he finally let go of I've got to make every investment decision to more of, I've got to approve the strategy and approve the thinking and kind of approve the process. He lives an awesome life. Like he's just freed himself. Like he just to go do all these wonderful things. He travels like crazy. He plays a ton of golf. But he's not out of his financial picture. To your comment of no one cares about your money more than you do. He still cares about it. He's still attuned to the macro, but he's hired out the day-to-day. So that's a little bit about what some of your investors are doing, right? They're tied into, hey, well, I want to tap into real estate. Somebody's going to go lease that that office building or that industrial or that multifamily property. Someone's doing the day-to-day. The extreme do-it-yourselfer is going to say, I need to go buy and flip my own SFRs. And boy, that's a business. That is a full-time business.
Full time.
So
They can have it.
yeah, exactly. Right. And so it's not that people can't and aren't capable. But boy, good partners can give you a lot of your time back.
Yes, they can. Yeah, we just like people to be really comfortable, and we understand, you have leaders that come out and they're very wealthy because they invested in real estate. And then other people want that and they don't know enough about that and they don't know how to find it or where to go or who to trust, just like what you brought up. So how do you find them? How do you get your name out there that you're the person to at least have a conversation with to get some sort of direction and some referrals to the right people? Right.
I think that's a concept that I would share is if you treated researching partners like a job, like you do, you're going to invest time somewhere. You're either going to invest time as a do-it-yourselfer and in like, I got to go be an SFR flipper. But if you took that same energy and you invested to, I got to find the right partner for myself. I'm going to work 15 hours a week and I'm going to Google and I'm going to interview. I'm going to talk to every single one of my friends and I'm going to see if someone's got all these components I wanted. In our case, people are looking for tax planning and, private investing and real estate and all these multifamily office services in one house. Like, we do our best to get out there and get our word out there, but someone's got to maybe network their way into us or find us. If that's the choice you make, I think the choice you make is either I'm going to learn all these lessons on my own, or I can invest that same energy, 15 hours a week, 20 hours a week for 6 months to find someone that says, ooh, that's an offering that I think caters to me. And then all of a sudden you freed up the next 20 years. I think that's the part that I see people not doing as much. They don't spend that much time really trying to find the right partner. And if they did, I feel like people would be really, really happy with what the results were.
I have to think about that, because I would agree that there's a group that doesn't, I mean, a group of people, not that they're all the same group, that just want to go find the deal and then don't know enough about how to make sure that's the right deal or the good partners or any of that. And then they want to come into I mean, I met people that come in as part of the GP team, and their job is to raise capital, and they have no idea how to talk to people about how to invest and how to be secure in that and all the stuff that goes along with it. It's not easy. It's complicated. And people have to be educated, or they're going to hold you responsible if the deal doesn't go well, especially if you're part of the GP team, I would think. Jana.
Yeah, can we stop the sharing?
Oh, sorry, yes.
Yeah, but I have a question, or it's from an observation, a personal observation. When we're working in these alternative investments, or you get to a point where you decide that alternative investments probably are a nice diversification to your portfolio, you're at odds with a whole part of the industry who is motivated to keep you in stock-based portfolios. I guess taking like the 30,000 feet level, I don't think that's what's best for most people, and yet we have a whole industry who spends a lot of time and money to keep us stock-based.
Yeah, I would agree with that, and there are reasons for them wanting to do that, and that's because it's so easy to manage large numbers, large dollar amounts with clicks of buttons, and the kind of diligence work that we do on investments we make. There's a real estate debt deal we're going to do. We're going to invest in some affordable housing, finance, it's kind of a doing well by doing good. We're going to finance the development of new affordable housing projects. When it's all said and done, we actually expect a cash flow of 10% federally tax-free. So we think that's a pretty exciting return from a debt position. But that due diligence took 7 months. Most RIAs that we compete with have no interest in doing that, right? When they can click a button and put you into some sort of S&P 500 ETF fund, some large cap value fund. So I would agree that we observe the same thing, that there are huge swaths of advisors and others that want to keep people exclusively stock-based. We do see value in stock and bonds and having liquidity, right? Individuals, especially when net worth and means are kind of below $5 million, the ability to immediately access capital for an emergency or a family need is super important. And you can click sell and get liquid on stocks on most every day. Same with bonds. So there's value to the liquidity piece. I think I agree with you that I wish more people appreciated the value that alternatives bring, and we're more well versed to talk about them. Frankly, that's how we make a living right now. Like when we tell our families what we're doing for them, it's surprising how little they've heard about some of these other opportunities.
Yeah, is this a professional like how would somebody find a firm that has more of a full portfolio type of view? Is that a designation, and is there a net worth or some criteria when it makes sense to do so?
Yeah, good question. There's a loose vocabulary around it. So if you're so family office is kind of where it starts, and multifamily offices are kind of where we reside. So if you're a Jeff Bezos and you have several $1 billion, you're going to hire out an entire team, and you're going to start a company to manage all aspects of your financial life. So that, they're going to do stock and tax and real estate and all of that, right? So you have this actual team that you've hired. If you're not Jeff Bezos, and you have, call it in the hundreds of millions, there's a point at which it doesn't make sense for you to hire out your own team. Somewhere there's an inflection point between under $1 billion and maybe 300 to 400 million, where it's like, hey, maybe it's worth having a team if you're north of 500 million and to have your own family office. But inside of that, hiring a group like ours, in which to answer your question directly, being a multifamily office, that implies that the offering has breadth. That we're bringing to the table more than just a 60-40 stock and bond portfolio. We're bringing tax planning, we're bringing business planning, we're bringing generational legacy transfer, wealth transfer ideas. We're bringing alts. So that would be at least one searchable term, multifamily office. That we speak to that on our website a little bit, like this is what we bring, right? So our partnership is super diverse. If you go to Morgan Stanley, you go to one of these big firms, you're going to find a certified financial planner, right? And they may have these little areas or these silos where they can help tap into expertise, but they're going to be initially focused probably as an RA on just that, what can I access from my computer? For us, our partnership, there's four of us. There's myself, which had a 15-year career in real estate. I have a partner who had a 10-year career as a single family office private market specialist, Jason Campbell, worked with a $500 million family office putting together funds, private equity and credit investments. Third partner who's a certified financial planner of 16 years, so does a holistic wealth management planning. And a fourth partner who's CPA and tax. So when you find a partnership like that, you know that when you're getting that sort of breadth. Like you just don't, if you just call Raymond James, like, just a guy that's, hey, I've managed 50 million bucks and I'm in your local strip mall. That's not what their partnership is going to look like. So I hope that search term, I'm trying to think there's other search terms that might imply breadth. But that's one of them.
Hey, you brought up something. Oh, yes, go ahead, Ted.
Really quick question, I guess. To what published indexes do you compare your performances?
Yeah, when we're referencing stock returns, we usually focus on the S&P. When we talk about bond returns, we usually talk about the Ag Index, which I think has about an average expected duration of around 5 to 6 years. Bonds are interesting because there's such different durations, right? So there's 3-month bonds and 30-year bonds. So it just depends a little bit on what we're doing in the public markets. If we're doing a private market investment, we're not benchmarking to public. So one of our diversified funds is a multi-strategy fund that has real estate, private equity, and credit in it. And we just have an absolute return number there. We would love to deliver 10 to 15% IRRs in this fund. And so that's kind of its own benchmark, is our stated objective. And I think we delivered a 9 in our first year of existence, and we're seem to be tracking as we ramp up and deploy, we seem to be tracking towards that.
That answer your question, Ted?
The statistics that I've been seeing over the years is that something like 90% of the managed money performs worse than the non-managed indexes.
Yeah, and that's part of why at our firm we focus so much on alternatives, is that dynamic you just described. So something we don't historically do is aggressively pick stocks. So there's a number of groups that will run what's called a concentrated portfolio, and they might say we want to try to pick the 20 or 30 best stocks and try to outperform the S&P in that. That is not what our group does. We like to get stock market exposure through a balanced group of ETFs, which focus on characteristics such as large cap value, small cap growth. And we basically balance and blend that based on the risks we see in the market. So if we have concerns about maybe a recession, or they've had an inverted yield curve for a really long time, which often is a leading indicator to potential recession. There's no guarantees, right? But when your bond yield curve gets really out of whack, it's often because there's a recession risk that people are seeing. So then we might balance those ETFs a little bit differently and try to focus on a more conservative bent instead of a growth bent. All to say, we think it's really, really hard to outperform the major indexes. And so we focus our time on trying to get our clients access to investments where we can add diversification and value and potential return outperformance.
But if it's so hard to outperform indexes, then why shouldn't the typical investor just go to indexes?
Well, let me ask you this. If I told you that the average return on private equity over 20 years was 14, and the average return on the S&P was 8, which would you rather have, 14 or 8?
Oh, I'll go for greed.
Issue is what indexes are available in the alternative markets.
That's the question. And one that we'd be happy to answer offline. That's what we do. How do you access that, right? How do you get access to that? You've asked the right question.
Now, presumably the pros are supposed to know how to access it.
He's a pro.
Yeah.
That's what they do.
Yeah.
So on another subject, because I just heard what you introduced your partners, but you did bring up transition. And my understanding is transition of the wealth in the family offices themselves can be very, very challenging. And I have an idea as to why. You don't have a specialist that deals in that. That's a tough job. That's not an income job. It's a job where you sit down with people at a table and bring in lunch or whatever and listen to what everybody says and do a lot of brainstorming.
Yeah, we call that soft planning versus the structural planning. So a couple thoughts on that. There are resources that we do use especially when there's friction. So I think there's a couple of tools that we do use on behalf of our clients. One is proactive family governance meetings and structures. So we do offer that to some of our families to say, hey, let's proactively get ahead of what's coming in 10 years from now or 15 years from now, and talk about what culturally you want to share, what values around your wealth do you want your family to have, and get proactive on that. There are structures we can use. So my partner, Jason Campbell, I mentioned, he helped the family of which there were 3 generations, right? You had people who were in their 80s living in Wyoming on, 100-acre plots that you didn't even have a telephone. And you had, sort of, quasi millennials, very different views on how to invest, what they're wanting from it. There's planning that can be done using structures, fund structures and shares and buyouts that can simplify those conversations. So I would say, so we do some of that as well. We say, hey, let's structurally put this together in such a way that people can choose or choose not to participate in a certain way. Or if they're focused on wanting a capital gain instead of income, they could sell some of their shares to other family members. So there are ways to utilize structures to help that conversation around the table that can be awkward, and say, let's see if we can create something that allows for each party to have a view. And the third thing I would say is when there is a friction moment, then we do bring a third party in that we like to say, hey, let's resolve. So we get proactive, we structure on the front end, and if there is a friction moment, then we bring in an expert who does that, all day, every day. Like
Counseling.
that's that Sherpa part, right? Where it's like, hey, I'm here to kind of shepherd you to a solution, right? And not sell you on my heritage, hiking shoes, but to say, this guy's the hiking shoe expert, and I think you need to spend time here.
Oh, I agree. And then I always wonder, well, when do matriarchs and patriarchs start having the conversations with their children? And my theory is, if you don't get them by 5, you're way too late. You've got to get them very, very early, and it's really simple. It's the simplest thing people can do, and they just don't realize how simple it is. I have a 10-year-old nephew who totally understands money, and he is now the big negotiator with his father of what he's going to pay for and what his dad's going to pay for. So
that's the only downside, right? You create a beautiful negotiator that negotiates against you, but that's fantastic. That's fantastic at 10, right? He's equipped to say, hey, here's I'm thinking about this.
Yeah, we started him at 3.
Yeah, that's awesome.
And so he's negotiates with his dad stuff. I love the stories. They're great. It's so much fun. And I don't know what generation he is. You know, we all have labels now, but he has conversations with his parents that I probably have never had in my life because he's so involved with the whole family and the whole family's friends. So, and everybody talks business in front of all their children and their trips and everything they're doing. And they, when they start talking about things that somebody else is doing, they're having conversations that are on an entrepreneurial level at the age of 10. So I should put that in my book.
It's great.
But why shouldn't that happen more often than it does?
Because parents don't think that the kids are old enough to understand money because they never understood money.
And somehow it became taboo to talk about money in front of kids for a long time. I don't know how.
Forever. There's still families that don't talk about money. They don't look at it as a tool. They look at it as whatever they look at it. I look at it
There's
as
an old story about a couple of guys talking in the bar about what they were going to do with their kids. And one of them said, you know, when my kid gets, you know, old enough, I'm going to buy him a bicycle. When he gets a little older, I'm going to buy him a car. And when he gets a little older, I'm going to buy him a college education. And when he gets a little older, I'm going to buy him a business. His friend looked at him and he says, you're going to deny your kid all of the experiences that made you successful. And that was a little hardship.
Yeah, J.C. Penney has a legendary story about that. I think he was 10 years old when his parents cut him off and said he was totally on his own to like for everything. And he took that as an opportunity and ran with it and, you know, built at the time an empire, you know, by just having to learn. Lots of different views on it, but I think what's undeniable is the need to at least start those conversations with our kids early and start to impart not just knowledge, but values, right? Not here's how money works, but, you know, here's how we'd like to put it to work.
Jay says most kids get unproductive money. Right. You got to put your money to work.
Well, I think he said unproductive money messages that burdens them more than helps.
Yes, I just read a article while I'm reading a book, Virgin, by what's his name, the Virgin guy. He was giving advice to a parent who was trying to support their kid in starting businesses, and he'd start a business and then he'd fail and then he'd start a business. He just couldn't make it happen. And here Richard is giving advice on here's how you could support them in that, and you could lend him some money to get him started, like, right, just talking about it. You know, he's been an entrepreneur since he was like 6 or 7. So he's got here we are again with the expertise of the right person who could be a great partner.
Mm-hmm.
And he believes that partnerships are so very, very important.
Mm-hmm.
And on that note, I would like to thank you very much. This has been a great discussion, a lot of fun. Jay, you have any more comments? Haig, you have any questions? David, you usually have something.
Well,
I go ahead.
You get the floor, Jay.
Oh, okay. So I was going to say, I'm sure the way you describe it, Peggy, you're talking to those 3-year-olds at an age appropriate level that give them a sense of responsibility and empowerment rather than intimidating them. And adults think kids shouldn't be in the money conversation because they don't understand the level at which they're talking, and they don't realize how critical it is to have that conversation at that child's level so that they feel empowered rather than, I don't understand this, and they get confused and have a meltdown, right? So the parents don't put in the time to understand, and never mind, in your ability to communicate is a marker for your ability to succeed with adults, for that matter. So it's really an art to be able to communicate to a child at their level how money works, if you have the right mindset yourself.
That's helpful for sure.
well said.
Well said. Thank you, Jay. Well, thank you very, very much, Greg, for coming on today. It was a lot of fun. It's been an adventure, and we do hope you'll come back again. We'd love to hear more. I would like to hear more about, I came up with a whole bunch of questions about multifamily and some of the things regarding multifamily. That would be a nice, different discussion to have.
Love to have it. Thank you so much for having me.
Thank you so much.